In the 7th lecture, double entry 7th lecture, we'll talk about credit purchases, buying goods on credit. So let's look at this transaction we have here. Transaction 1, on the 22nd of January 2016, we bought goods on credit from Kareen's Hardware, $23,000. So as usual, the first thing we're going to do is to decide what two accounts are affected by this transaction. Bought goods, which is purchases, and Kareen's Hardware. Alright, so let's just head up our T accounts that we already pre-drew. So the purchases account and Kareen's Hardware. Now, the next thing is we try and identify the category of accounts that both of these accounts belongs to. Since we just watched the cash purchases one, we know that the purchases account belongs to, the purchases account is an expense. Kareen's Hardware in this scenario, you might be wondering, so let's just think about it together. We're buying goods on credit from Kareen's Hardware. As a result of this transaction, we're going to owe money to Kareen's Hardware, which means in our business, Kareen's Hardware is a liability because the business owes Kareen Hardware money. Whenever the business owes money to whomever or whichever entity, it is a liability. No, the liability, Kareen's Hardware, we're buying goods on credit. The business is an accounts payable. And accounts payable is our current liabilities. It doesn't really matter what kind of liability Kareen's Hardware is, but we just need to be able to identify that this is a liability because we're now going to owe this entity money, and whenever the business owes money, it's a liability. And we need to identify that's a liability so we can now apply the double entry rule that's relating to liability. So now next we decide whether purchases is increasing or decreasing. And we know whenever we buy goods, we increase our purchases expense. There is no way of decreasing it when we sell goods. We don't decrease purchase expense when we sell goods. We increase sales revenue. So here we go. We're buying goods on credit, so we're increasing our expense. We're increasing the amount of expense that we'll incur. So to increase an expense, we debit. I realize that I'm telling you the double entry rules over and over again, even though you already know them. To increase an expense, you debit. And since this transaction is increasing purchases, we're going to debit our purchases account because it's an expense. So January 27, Kareen's Hardware, I'm shortening for space, amount $23,000. Kareen's Hardware, we've established already, is a liability. The double entry rule for liability says to increase, we credit, and to decrease, we debit. No, so tell me, is this transaction actually increasing the amount of money we're going to owe to Kareen or decreasing the amount of money that our business will owe to Kareen's Hardware? It increases our liability because we trust in goods, we're taking goods on credit, it will increase the amount of money we owe to whomever. To increase the liability, we credit, so we credit Kareen's Hardware with this transaction. January 27, purchases, amount $23,000. And that's how we record this transaction. Please see next lecture, lecture 7, to see how we record a purchases return, us returning goods to Kareen's Hardware.